next video, what we're going to be doing is talking about bonds, both corporate and government bonds. In other words, what you're doing is you are lending money to either the government or to a company. Government bonds are basically pledges that they're going to repay you back, all right? And what they're going to do while you have loaned them that money, you bought the bond, they're going to pay you interest on that. And what they're doing is they're doing this to cover the cost of running the government, both all of the federal, the state, and then local municipalities that go along with that. You can buy bonds for all three of these, or any one. Now, let's look at the federal government. They basically sell three types of things: bills, notes, and bonds. A treasury bill is a short-term loan, anywhere from 1 month to a year in maturity. Most times people are looking at that, they're looking at maybe 3 to 6 months as far as the maturity of these T-bills, treasury bills. What they do is they sell them at a discount. So for example, for a $100 bond, you might buy it at $95. And then when it matures, they're going to pay you $100. So what's happened is the interest is basically kind of built in at the end. So what they do is they discount it. When you get it, you've gotten the interest that goes with it. Now, you do pay federal but not state taxes on any of the interest that's earned as far as treasury bills are concerned. Now, treasury notes are longer term. In other words, anywhere from 2 to 10 years as far as their maturity is concerned. And what they do is they pay interest every 6 months. So what will happen is you might buy some treasury notes, and maybe they're maturing 5 years down the road. Every 6 months you're going to get an interest, a check in the mail for interest on these notes that you have purchased, where you are lending the company or lending the country money. Treasury bonds are long term. In other words, 30-year maturity dates on this. Interest rates are higher because you're lending them money for longer periods of time. And again, the interest is paid every 6 months. Now, in the book, it also talks about these treasury inflation-protected securities. Don't worry about it. This kind of gives you the differences between the bills, notes, and bonds as far as how the interest is done and what kind of interest that they're actually paying on these. Now, a municipal bond is where the state or a local government will issue these bonds to try to do something. Maybe they're building a new airport or something along those lines. What they will do is they will issue a series of bonds to try to get the money to do that. And what they'll do is they will pay you about every 6 months interest on what it is that you've gotten. And at the end of the loan, they pay you the total amount back. Key characteristics: the interest is exempt from federal taxes. So in other words, you don't have to pay federal income taxes on any kind of munis that you may buy. Now, let's say that you buy a municipal bond at 100 and then you might sell it. You might decide to sell it and you sell it for 105. You have just had a capital gain. In other words, that the value of that has gone up by $5, and so you'll have to pay a tax on that, capital gains tax. Now, there are two different types of munis. You have general obligation and revenue. General obligation is basically saying, I promise to pay you back, all right? With revenue bonds, what they're doing is they are taking the revenue from the project that was created from that loan and paying back the bonds from that, such as, like they say here, a toll bridge. Because with a toll bridge, you're paying every time you go over it, and what they're doing is they're taking the money from the tolls and paying back the loans for those. This talks about taxable equivalent yield based on your tax rate and things like that. You can go through and calculate this, where the tax-exempt bond is paying 5% and you're in a 28% tax bracket. Because you're not having to pay the taxes on that, it's actually yielding about 7% instead of the 5%. So one of the advantages of a municipal bond is that the yield, or what you actually earn, is actually more than what's stated on the coupon. Now, a corporate bond is where a company is taking on a big project and they're needing big loans, and what they're doing is they're issuing these bonds for the project. So maybe what they're doing is building a new plant or something like that. What they'll do is they will then issue these bonds. You buy a bond, you're making them a loan, and they'll pay you interest about every 6 months. Now, they are safer than stocks, because if a company goes belly up, they have to pay off the bondholders before they pay the stockholders. And it's considered fixed income security because you get the same amount of income every year. What happens is, here are some terms to think about. You have to think about the face value. In other words, normally with corporate bonds, they're issued in thousands. There's a maturity date. In other words, it might be 10, 15, 30 years down the road. An indenture is a document that describes what the thing is really all about. The trustee is typically a bank, a big money bank, that acts as the bondholder's representative to handle all of the transactions for those bonds. They sell them to raise money for major purchases, improve their leverage, things like that. A debenture is unsecured. In other words, they can issue a loan that is unsecured. In other words, if they default on it, you don't get anything. Or they could have a secured bond. In other words, okay, what we're going to do is we're going to build a plant, and we're going to secure that loan with the land and then with the building that it's actually being created. So if they default, the people who own the bonds can claim access to and ownership of that land and building. A convertible bond is something that can be swapped for stock. High yield bond, that's where you talk about junk bonds, okay? Companies that don't have much in the way of credit, and there's a good possibility that you're not going to get your money back. There may be also a call feature with the bond. In other words, let's say that a company issues a bond that's due in 2035. They decide to pay off the loan early. They can call that bond. In other words, you have to give it back to them. You have to sell it back to them at a certain price if they decide to call it. A sinking fund is where a company will set up kind of like a savings account. What they're doing is, as they're making money and things like that, they'll put money aside in a sinking fund to pay off any of those bonds or those loans that they have issued. Now, with a bond, what's happening is you're getting interest income. In other words, let's say with one of those government bonds, let's say a T-note, you're getting, say, 3% interest on it. What'll happen is that interest comes in every 6 months. Same thing with corporate. You're getting the interest off of that. Now, you can also sell bonds at a different price than what you purchased them, okay? Because sometimes interest rates will change, which will change the price that people would be willing to pay for a particular bond. Let's say that interest rates are going at 5%. All of a sudden, interest rates go up to 6%. Well, you could buy a bond that has 6% at that point in time, or you could buy that 5%. Well, I'd rather have the 6%. So what they will do is then discount the price of the bond. Instead of $100 or $1,000, it might be $990. You pay $990 for that $1,000 bond to make up for the increase in the interest payment that you're not getting. Let's say that you have a 6% bond and interest rates are now going for 5%. And so if you're going to buy that, if you're going to sell that, you're going to want more for it than what you could have gotten. So the price of the bond is going to vary with the interest rates that go out there, and also with the maturity dates. Sources of information, you can go all over the place to try to get some information as far as what are some of the bonds, what are the prices, and things like that. Moody's, Standard & Poor's will show you what the ratings on those bonds and the companies are. Because if you think about it, if you're going to buy a bond, you want to buy something where you're pretty sure that you're going to get your money back. Well, the higher the grade, the more creditworthy the company, the lower the interest is going to be. The worse the credit rating, the higher the interest is going to be. So you have to think about, okay, am I willing to take a risk for this higher interest and possibly lose my money if they default on the loan? This talks about the calculations as far as bond yields and things like that. You can go through and go through the formulas, or there's places out on the internet where it will actually calculate it for you by putting in some of the information. Now this is interesting because this gives you an idea as far as what we mean by yields and coupons and things like that. Let's say that Home Depot has issued several different bonds, and you can see the maturity dates on these bonds. One is maturing in 2021, 2027, and 2036. You can see the interest rates that they're actually paying on these. Well, the reason why the price is less than 100 on these is because interest rates are actually higher at this point in time. So the yield to date, the yield that's actually going out there, people are looking for something that's higher than just these stated here. So that's why the price is discounted. Another thing to think about is this has a longer maturity date, which means that your money may be tied up longer. So you would want a higher interest rate to go along with that. So you're going to pay less than what you would for something that's maturing sooner. You'll notice that it has a really good rating, AA rating in this case. And what it talks about here is the discounting and things like this. So as far as a summary, make sure that your investment goals are specific and measurable. Make sure that you have set aside the money that's necessary for your emergency fund and you're paying yourself first. You get your financial house in order before you start setting up an investment plan. You have to think about safety versus risk, income growth, and liquidity. Also think about how you're going to allocate your assets. In other words, how are you going to diversify that? The younger you are, the more risk you can take. The older you are, the less risk you want to take. You want to think about what kind of investment returns you're going to get. Get some help. Get some help as far as what it is you want to invest in and also what your tax situation is going to do to you. You have conservative investments like savings accounts, CDs, money markets, and savings bonds. We'll talk about some of these a little bit later on. Also, think about government securities as a safe harbor. In other words, that's the safest that you can get. Municipals are conservative investments and give you a little bit more income as far as the interest that they pay. Bonds are also issued by corporations so that they can get loans to do massive projects. So these are some things to think about as far as Chapter 11 is concerned. If you have questions, give me a shout.